Hello, everyone, and welcome to Real Estate Right Now, where we talk about real estate matters that matter to you. We are live here from Linda Craft Team Studios here in Raleigh, North Carolina, part of the Research Triangle Park. Today, we're going to talk about a couple things that have recently happened in the world of real estate and lending and banking and everything that we have. But one is we're all aware of that SVB, otherwise known as Silicon Valley Bank, had a run on the bank. And what was that, and how does it affect you as somebody who may be wanting to purchase home, and maybe there's no effect. We're going to find that out. We're also going to talk about that yesterday we had a little bit of a rate hike from the Federal Reserve, and so maybe we need to find out what that impact is. And my guest who's going to help us do that is no stranger to the show. His name is Doug Schoonmaker. He is the vice president of I'm going to get it. United Community Bank. There it is. Because I was going to say something else and it just didn't come out right. Sorry about that, Doug. Doug, welcome back to the show.
Thanks, Jay. Thanks for having me.
Wow. United Community Bank. I wanted to say United Unity, and it just was not coming out right.
Hibbity.
Yeah, it was awful. It was awful. But okay. So let's just dig right into this. All right. So Silicon Valley Bank, otherwise SVB.
Mm-hmm.
All right. Is collapse an appropriate word?
Collapse, yeah. They had a bank run, of deposits.
Okay, so what happened there? From your perspective, what happened?
Yeah, I mean, from my perspective is, they were a bank specifically built around VCs or venture capitalists and tech companies. And that's where the lion's share of their deposits came from, was from those types of organizations. Very small retail brick and mortar presence, based out of California, a little bit in Boston.
Right.
But yeah, they got caught.
So it was high risk.
High risk bank. Yes.
It was a really high risk bank, and
that was not diversified.
And it wasn't diversified. And that was a problem. Okay.
Correct.
So we saw a little bit of a ripple effect. Who was it affecting after that? Where did the ripple go?
The first one that you saw was Signature Bank out of New York City. My understanding is that they were heavy into crypto.
Oh, okay.
Cryptocurrency,
which has been having some problems as recent.
Yeah, they've been down quite a bit.
Yeah.
So state of New York took them over, and now they're going to be bought out by another New York Community Bank.
Okay.
On pennies for the dollar, but then you saw Credit Suisse.
Yeah.
They got rescued,
UBS?
UBS, that's right.
Right. Did I read that UBS bought them?
Yes.
Right?
Yep, they picked them up. Yeah. Once again, pennies on the dollar.
Oh, wow.
Yeah. So good for them.
Yeah. Okay. So how about on a more local level? Do we see any ripple effect?
We do not.
Okay.
At least in the regional community bank sector, or the much bigger, larger banks, we don't see that. Now, SVB was a very large bank,
right?
And it was the biggest failure since WAMU back in 2008. But just a completely different style of bank,
right?
Built around that business model of venture capitalists and startups and tech firms and things of that nature.
Right. So we're not seeing anything here that we need that somebody who's interested in buying real estate or anything should be worried about.
Not at all. Most of the banks around here are all very diversified, whether it's SBA lending, residential, home lending, consumer, personal, across the board, private wealth. They got their fingers in a little bit of everything.
So is that what I mean? If you were to describe, United Community Bank?
Yep.
I mean, what I mean, how do they protect themselves from something like that happening?
Having a diversified portfolio.
Okay.
Yeah.
Okay.
Not having too much in one bucket any given time, kind of evening that out.
Okay.
Yeah.
All right. We had another event that recently happened, and that was, we saw a little bit of a rate hike. I think it was a quarter of a point.
Yep, quarter point, blip in the radar.
Yeah.
It was already baked in. Everybody was expecting it already. Not much impact there.
Did they think it was going to be just this small? Because I thought that people thought it was maybe going to be a little higher, like as much as 3/4 of a point.
Prior to SVB and some of those other institutions, the shakeups there, it could have gone a quarter to a half is kind of where
Okay.
they were at, and then reverted back to a quarter. That's all they really felt was needed.
Mhm.
And we should stay pretty consistent for the rest of the year. In the rate hikes, we may see a small rate hike,
Mhm.
but we're not going to see that Fed funds rate or prime rate go down probably until 2024 sometime
Okay.
is when they'll start easing that a little bit to try to, keep inflation.
Well, because they're trying to slow it
They're
still.
trying to slow things down, consumer spending,
Right. How does it? But okay, all right. Here's the thing, though. The housing sector is responsible for thousands. One house is like 2,000 jobs or something. I can't remember what the number is
Yeah.
specifically, but it's like a couple thousand jobs per house
Mhm.
that of people who work that's affected.
Yeah.
How does this? I mean, when we're trying to slow this down in the housing market, how
Mhm.
does? I mean, how does it affect all that?
Things may have to tighten up at home a little bit, depending on what sector of employment that you're in, what, type
Mm,
of role that you're in. But essentially, it's still business as usual. Just,
mhm,
you have to tighten up just a little bit um, for things to kind of settle back down again because they really want to get to that 2% range
mhm,
of inflation, which is normal,
right.
to kind of get things back under
And
control.
we're not really close to that right now.
We're not close. Yeah.
Yeah,
Not even close.
yeah, to that right
Mhm.
now. So, from your perspective, in terms of what because we're coming into a spring market, and
Mhm.
typically in the spring market, we start to see, you know, people start to pick up in terms of
Yep.
buying purchases, sales, and that's so forth. Are you seeing any of that right now?
So I would say over the last 2 weeks, yes, we've seen an uptick in applications. I
Mhm.
think applications week over week were for new purchases were up about 10%, 7 to 10%, somewhere in that range. Obviously down since this time last year,
Mm.
where we were probably 30%, 35%, somewhere around there. But yeah, we've definitely seen an increase in interest in getting back out there.
Right. Even with though the rate, I mean, because the rates comparative, when did the rates start going up last year?
About a about a year ago.
Was it
Yeah,
was it about this time?
about
Was
this
it about
time last
March?
year.
Was
Yeah.
was this time last year?
Hmm.
And that kind of was starting to slow us down a little bit because we were at a buying frenzy.
Yeah, it may have been in January, February, but yeah, it
Yeah.
was,
Okay.
they jumped really quickly
Right. Okay.
during that time. And since then they've stayed in that 6% to
Right.
7% range from a 30-year fixed standpoint.
Mhm.
Ebbing and flowing depending on what the market conditions are doing.
Mhm. Are you seeing any particular price range of applications that seem to be more consistent than others as they come in?
Now it's really across the board
Really?
today. First time home buyers to, seven-figure purchase prices. I mean,
So well, first of all, we say first time home buyers,
mhm.
but this
It's a different world.
but this is a little bit different,
Yeah,
right?
yeah.
I mean, when I first got into this business some years ago, uh, right? You could buy a home for, first home for around 100 grand or less.
I was gonna say 60 to
Yeah,
100,
right.
somewhere in
Yeah.
there.
I mean, because you could get a really nice townhome
Yeah.
for around 60
Mhm.
to 80,
Yeah.
you know? I
Be
mean,
right behind North Hills. I
yeah,
mean,
I
yeah.
know, right. I know. I remember, right? And now the first time home buyer market is
300.
right.
I mean, realistically.
Right. And this is in 30 years.
Mhm.
This is a 30-year flip,
Yep.
right?
Mhm.
I want you to think about that.
Yeah.
We went
I
from
like that. Yeah.
60 to 80 to get in the door
Mhm.
in a townhome, and now we're looking at 300.
Yeah. It's crazy.
That's crazy.
Yeah.
So where do you see where are people
But I mean, and with that said too, Jay, like, what were your interest rates back then?
with 7 and a quarter, 7.5.
Okay. So it wasn't the 16,
No, that was the 80s.
yeah.
No,
Yeah.
now if you ask Linda when she started this business, right, back in 1985,
Hey, now be careful.
right? No, she
Mhm.
did,
Oh, yeah,
right?
I know.
Right? It's been over 38 years,
Yeah.
right? She was selling homes with 18%.
Yeah. People need a place to live. I
Right? I
mean,
no, I get it. But I mean, which by the way, homes were still selling at
mhm.
18%.
Yeah. So when you put it in perspective, 6 to 7%,
Right.
it's pretty attractive.
Right. When I got into the business in the late 90s, right, is when I got into this business. Right. And interest rates are around about 7 to 7.5, right?
Ditto. Yep.
Okay. And Linda had just come out of the 80s where they were 16 to 18%. She's thinking this is the greatest rate ever.
Yeah.
Right.
Yeah.
And-
Doing little dances.
oh gosh. Right. Because nobody flinched at 7.5%. I mean,
Yeah.
you may have been in junior high.
No, I got in this in 99. That's when I started.
Okay. So people were you getting complaints about 7.5?
No.
7.25?
No.
7.75?
No, not at all.
Nobody complained, right?
But we've been spoiled.
Right. So this is the point.
Yes, we've been spoiled.
This is the point I want people to understand. When we were at 16, 18%, which I didn't know because I wasn't in the business, right?
Yeah.
And you were you've been in the, if you were in the mortgage business then, or you were in the real estate business then,
Yeah.
and you saw that, and then you see it come down to 7.25, 7.5.
Yeah.
You're right. They're dancing. They're dancing because real estate's really, really good at that point.
Yep.
Right?
Lionel Richie dance in the streets.
Right. right. I mean, but we have been, at 3%.
Spoiled.
And now we're seeing 7.
I know. It's a mind shift.
It's such
a mind
right.
shift. Yes.
That's the thing, right? That people need to grab a hold of. It's like, okay, this is the same rate that I came into in 97 and everybody was thrilled. Thrilled.
Yes.
Now it's the same rate. Nobody's happy.
Yeah.
But it's the same rate.
Yeah. Yeah. But I mean, essentially it helped with affordability. People could buy a lot more,
Right. Okay. Yeah.
bang for their buck from that standpoint. So it is tough when you go from 3 to 7.
Right.
From an affordability standpoint.
Right. And then true, the cost of housing was.
Cost of housing, we're fortunately in a very good market here in the Triangle.
Right.
That great appreciation.
Right.
Downside is it's hurt affordability from that perspective.
Right. Yeah. It's just, and I don't know how to balance that. I don't know, you're in this business and I don't know how to balance that idea of, because we just talked, I could get in 1997, $60,000, $80,000 into a pretty nice townhome. And now that townhome is now $300,000,
It may not be quite as nice.
Yeah. But it's $300,000 and it's the same interest rate.
Yeah.
But then again, I wasn't making, right. We weren't making as much money.
That is correct.
So is it all relative really? Or has things gotten a little bit ahead of us?
I mean, we could go on forever about this, Jay. I mean, we also didn't have the student loan issues that we had back then.
Right.
That we have currently as well. So, that comes into play big time in our current world.
But in terms of buying and selling real estate though, it's still a factor.
It's still a factor. Yeah.
Why is it such a big factor?
Like in terms of what?
I mean, well, you bring up the student loan piece.
Yeah.
How's that such a?
Because school is expensive. I mean,
I see what you're saying.
I mean, schools are expensive and, families don't have money, 30, 60 grand to pay towards their kids' ongoing education after, high school.
Right. Okay.
So take on student loan debts, and they've been fortunate for the past, 2-3 years now to be in forbearance and not have to make payments and things of that nature, but it still has to be taken into consideration in the grand scheme of things when we're qualifying people. Because eventually they're going to have to pay on it.
Right. Okay. So speaking of qualifying then, right? Somebody has a student loan. How do you handle that now?
It really depends on the end product. And what I mean by that, whether they're going with the FHA loan, a regular agency conforming type loan, whether it's Fannie or Freddie, they all have a little bit different rules and how they look at that. So for example, Fannie Mae, you take 1% of whatever the balance is, and you have to use that as a factor when qualifying. Whereas Freddie Mac FHA is only 0.5%.
Oh, wow. So if you were in graduate school and you're working on your MD and then you had all that, and
you can imagine.
Oh, well, it's 6 figures in loans. And it's going to go at 1%.
Yeah.
And that could be a little bit detrimental.
Yeah.
Okay, I
Yeah.
can see that now.
It tightens that box a lot more.
Right. What type of programs, with the interest rates that we're seeing, with everything
Mhm.
else that's going on, what type of programs are you offering now to people, or that are available, that products that maybe you have,
Yeah.
that people can use to
Yeah.
help
I
them
mean,
get to?
so, you have the NC housing loans, the USDA loans, things of that nature, which are 100%. Some have down payment assistance, monies attached to them, things of that nature. A proprietary loan program that we have at United Community Bank is our PATH program, which is possibilities achieved through home ownership.
Mhm.
Essentially 100% financing, no mortgage insurance, 30-year fixed, below market rates. It's just a really, really fantastic program for our first-time home buyers and getting in.
So what other type of programs outside of first time home buyers?
Mhm.
Is there some other programs or unique programs that you have right now for other price ranges, or?
Yeah, I mean, we really anything and everything for the most part across the gamut, whether it's um, physician loans, which are 100%, dentist, nurse practitioners, pharmacists. We do construction and perm lending as well, renovation loans, really anything and everything for, within reason,
Right.
we can handle.
Okay. What do you think is one of the biggest hurdles that the real estate market is going to have to overcome right now, beyond inflation?
Just inventory is still an issue, right? I
Okay.
mean, you see it, I see
Yeah.
it. I've been working with some people for over a year and a half now,
Mm.
and you know, they're still looking. They still have not found something, whether they're being outbid or there's just not enough stuff out there
Mhm.
that sparks their interest. They're just sitting on the fence now. So, part of it is people have those 2%, 3% interest rates and don't
Mhm.
want to get rid of them.
Right,
So
right, right, right,
they're
right, right.
so
So they're
they're going to
sitting,
they're sitting tight.
they're
Yeah.
sitting tight.
Yeah.
And now, are you seeing people maybe push more towards new homes, or is that still a problem?
No, that's actually I just saw a new home sales report and they're actually up right now.
Mm.
So those are, people are gravitating towards that
Mhm.
just because it is inventory. Now, actual physical houses on the ground, that's a different thing versus
Mm.
signed contracts. A
Got
lot
it.
of these signed contracts that they're putting in the new home sales reports are not actual houses yet. They haven't even broken ground.
I got it.
So it's a little misleading from that standpoint.
So they're not. It's okay. They made the contract, but there's no physical house to move
There's no
into.
physical house. Yeah, they're
Okay.
still, maybe a year out.
So are we still seeing supply chain issues?
Not quite as bad. It's caught up from that standpoint. I
Okay.
feel like, obviously I'm not out there all day every day,
Right. Yeah.
with my construction hat on, but
I-
for all intents and purposes,
Yeah.
I think it's back in control to a certain degree. You're always
Okay.
gonna have some outliers with factories having issues or whatever the case may be, whether it's cabinets or window packages or whatever the case may be. But all in all, I feel with the construction loans that I've been doing that things are back fairly normal at this point.
Cost of the cost of materials, are they settling, or is it still on the rise? Are we still in an inflationary?
I would say inflationary, and depending on what supplies we're talking about, those ebb and flow a little bit too.
Okay.
Whether it's framing materials,
Mhm.
to whatever else, it's still going up and down.
Okay.
So it's about timing.
Okay.
Yeah.
So what are some of the other challenges that you foresee in the future in terms of the real estate market, and maybe even lending from your part?
Mhm.
What are some of the foreseeable challenges? Or maybe there's not, or maybe there's maybe, if there's maybe a bright spot that you're seeing that gives you a little hope. What would be maybe a bright spot or a challenge that you're looking at?
I mean, the Fed spoke yesterday indicating that they're going to start tightening credits. What does that mean?
Yeah.
Well, it fortunately means nothing in regards to residential home mortgages. It's, business as usual from that standpoint.
Mm.
It's the other sectors where they're trying to tighten things up a little bit.
Mhm.
But, we're going to be still doing loans, putting them on the balance sheet, selling them to Fannie Mae, Freddie Mac, HUD. USDA, VA,
Right.
things of that nature. So, that's good. From a rate perspective, we would all love to see rates drop, right?
Right.
But I don't foresee that happening in the near future. I think we're going to stay in that 6 to 7% range,
Mm,
at least through the end of the year, maybe longer.
okay.
But it's just my personal opinion, which
Okay, let's talk about reality of rates.
mhm,
We had one of your colleagues on here who brought charts and historical charts
yeah,
of rates,
yeah,
right? We
yeah,
all know him. We love Paul,
no,
right?
P50.
Yeah,
Mhm.
but he brought a series of charts with us
Mhm.
to talk about rates and all of those things. Do you think it's realistic that we'll see that 3% rate?
I would say no.
Yeah.
I would love to say yes.
Yeah, I know, right?
It's tough.
Yeah.
Excuse me. But yeah, I think, that's going to be something we look back into history going, wow, did that really just happen?
Right.
You know, we were really fortunate to be living during that time.
Yeah, right. I
Yeah.
mean, I don't do you think okay, because I listen, I'm not a guru in this. Matter of
Mhm.
fact, my graduate stats classes I only have 15 hours,
Yeah.
so I can do the stats for you, but
Mhm.
it doesn't necessarily mean anything.
Yeah.
They're predictive statistics.
Yeah. Accuracy.
Yeah. Well,
Yeah.
right. Here's what we know, right? Statistics don't lie, but statisticians do.
Yeah.
So, and we can be quite good at it. By the way,
Yeah.
just tell me what you want,
Yeah.
and I
And
can
I
get
can
you.
make it
I can
happen.
make it happen for you. Do you think 5% is realistic?
Yes, without a doubt.
Okay.
Yeah. That's a normalized market type rate.
Okay. So we're looking at, maybe a 2% adjustment.
Yeah. I could see that's
Okay.
within the next year or two. I could definitely
Okay.
see that happening. Now, I don't think you should wait for that to happen
Right.
because what does that happen? Well, then there's increased demand,
Right.
right?
Right.
Then housing prices go up.
Right.
There's more competition.
Right.
Right now there's less competition, less buyers out there because of people being
Right.
pushed away or scared, or think rates are going to come down, which realistically they're not going to. Like you said, we're not going to go back to that 3%
Right.
range. So get in. I mean, get in while you can.
Yeah. Get in now.
Yeah.
While you can
Yeah.
get in.
And then ride the wave.
Right, and then ride it out,
Mhm.
for maybe ride it out for a couple of years, but at
Yeah.
least you're in because if you there's a problem with waiting, isn't there? That if you do wait, it could be too late.
I like that.
Yeah,
That's good.
right, because then
So true though.
right, well, and especially because we're working with such a thin inventory.
Mhm. I mean, how many people are moving to Raleigh Durham on a daily basis?
Well, we had the guy who does the TAR report in here,
Yes.
Stacy.
Anderson.
Yeah, Anderson was in with us, right? And I said, what is that number? Because we debate. Is it 100? I hear 190 people a day,
Yeah,
and I
yeah.
said, he goes, Jay, we don't know what that number is. Here's what I'm going to tell you. Here's what he said. He said, here's what I'm going to tell you. There are more people moving in than are moving out.
Yes.
And it's significant.
Yes.
That's the only way I can phrase it to you.
Yep.
Is that there are far more people moving into this area than moving out, and we don't have enough inventory to handle all those that are moving in.
Yep.
And they're coming from all over. And he said, we're seeing an increase because we're seeing a lot of people filter in from the West Coast,
Yep.
specifically California.
Yep.
And we're seeing a lot of people come out of New York and New Jersey,
Mhm.
right? And then we're seeing halfbacks,
Mhm.
people, right?
Yep.
What people don't know what halfbacks are. These are people who were in New York, moved to Florida,
Mhm.
and then now they're coming halfway back.
Yep.
And he said, but that significant influx from up north, and from the bigger cities,
Mhm.
the metro
Yep.
areas, and California has been just a significant sweep.
Yeah.
We don't have the inventory.
Yes. Or the land.
No, you're right. Right. And by the way, we don't have the infrastructure.
Yeah. Without a doubt. Yeah.
To handle it.
Yeah.
Right. But by the way, those are actually kind of good things for the real estate market, isn't it?
That's fantastic.
Right.
To our point, get in while you can, right?
Don't wait or it's too late.
Don't wait until it's too late.
Right. Yeah. Right.
Or it's too late, I guess is what you said.
Yeah.
Right?
Or it's too late.
Yeah.
Right. Yeah. It's too late. Right. Which, by the way, you gave me you gave me marry the house and date the rate,
Yeah,
which is awesome.
yeah.
Yeah, so I'll give you that one. And that was a shoot from the hip right there too. By the way, uh, this has been really fun and educational. I mean, I just think this conversation, these are the conversations that I think people who are watching need to have with you. They should be
Mhm.
asking you these questions. How does the SVB affect?
Yep.
Does it mean I should stay away from the market? Does a quarter interest rate, does that mean I should stay away, or should I get in faster? Or these are the conversations that you need to be having
Yeah.
with your lender and with your real estate agent.
Correct.
And these are very real conversations. You shouldn't be, that's what we do on the show. We're trying to talk about things that you should be talking about,
Mhm.
right? And hopefully giving you a little more clarity.
Yeah.
This has been fun.
It's always a good time with you.
I
Joe.
mean, this has been fun. I mean, this is kind of a low key, casual conversation, but the conversation really got fun.
Yeah.
It was
like coffee talk,
It really was, and it was enjoyable. I mean, it's like we're doing the show, and it's like going. All of a sudden, we had a couple things planned, but then the kind of dovetails.
It diverts and kind of flows.
But it's the conversations that we should be having, so that we could talk ourselves through. You know what? Talk to your spouse, talk to your significant other. These are the conversations we should be having, because we should get in now. Tell people how they can get a hold of you.
Yeah, you can call me at 919-656-0822. You can visit me online on my website at www.applywithdoug.com.
Apply with Doug.
Yeah.
Is that new?
No.
Really?
I branded that about a decade ago.
Really?
Yeah.
Apply with Doug.
Bought the domain and
applywithdoug.com.
Doug Schoonmaker. Schoonmaker's it's a different last name, so it's a little harder to find that or spell that when you're in Google trying to find me.
Yeah. Well, and it's a lot of letters.
It's a lot of letters.
And you know what? We're lazy.
Yeah.
I have a 4-letter name and nobody still can understand how to spell it. So it's all good.
Yeah.
Thanks for being with us, Doug.
No, man, I appreciate it.
Hey, folks, listen, this is the show. We're Real Estate Right Now, where we talk about real estate matters. We just had a really nice casual conversation about things that you should be talking about with your lender, things that you should be talking about with your real estate agent to help bring clarity. You know what? Get in now. Don't wait before it's too late. You know what? We're going to be back next week with another great guest. It's going to be another great show. As I say to you every week, all over the world, and especially to our new friends on DBTV watching us on Saturdays. You know what? You had a lot of choices. You chose us. Thank you so much. And as I say to you everywhere all over the world, ciao, everybody.
Thank you.
All right.